Friends, today we will be starting with the chapter of capital budgeting. Now, the chapter of capital budgeting, which we have already learned at our IPCC level, the one that we learned at IPCC level was at basic levels. Now, at final CA, it will be a bit at advanced level. But the logic behind the chapter which we have learned at IPCC and what we are going to learn at final say, the logic, the basic is the same. Now, let us understand first what is the meaning of the chapter capital budgeting and what exactly we're gonna do in this chapter. Capital budgeting. Budgeting for capital expenditures is nothing but capital budgeting. Or friends, if I want to put it in simple words, whenever we take decisions in respect of long-term assets or fixed assets or capital expenditure or capital projects, whenever we take decisions in respect of these assets, those decisions can be termed as capital budgeting decisions. So actually what I can do is I can add a word here, decisions. So if we take decisions in respect of any of these assets, that is fixed assets, capital asset, long-term projects, capital expenditure, any decisions taken can be termed as capital budgeting decisions. Let's take example. Example goes this way: setting up of a new branch, purchasing a new machinery, replacing an existing machine with a new one, starting a new product line. These are all examples of capital budgeting decisions. Now friends, when I was talking about these examples, do you agree the unique part that I can say of these examples was what? If suppose I plan to start a new branch, or if I plan to purchase a new machinery, the outflows associated with these projects will be immediate. If exercise the opportunity to go for setting up of a branch or to purchase a new machinery, the outflow that will be there will be immediate, but the inflows associated with the project will be spread over a number of years. And friends, what we have to do in this entire chapter, we have to just compare the outflow with that of the inflows. And if you think the inflows will be more than the outflows, then go for the project. If not, then don't go for the project. Now, let me take a simple example to clear my point, what exactly I'm trying to convey a message. Suppose we are planning to purchase a new machinery. You did a market research and you realize that the cost of the machinery is say rupees 5 lakh. So machinery is going to cost us rupees 5 lakh. After doing the market research, you realize that this machinery is going to have a life of say 3 years. So that means this machine can work for a period of 3 years. But your friends, tell me, what is the use of purchasing this machinery? This machinery will help me to produce and sell goods for how many years? For 3 years. So what I will do is, now I am planning to decide, should I purchase this machinery or not? If purchase, outflow will be immediate. This machinery will help me to produce and sell goods for a period of 3 years. So then what will I do? I will now estimate what will be the amount of cash inflows by manufacturing and selling those products for a period of 3 years. How much cash inflow I am likely to generate? The question here is, friends, the cash inflows which we will consider here, are these cash inflows going to occur right now or in future? Future. So I will now estimate how much cash inflow I am likely to generate. Understand these words, because all these cash inflows that we are going to write here will be purely estimates. I will estimate how much I am likely to generate in future, and then compare that future value of cash inflows with that of the present value of the cash outflow. If suppose I think the cash inflows will exceed the cash outflows, then I should definitely go for the project. If not, then I should not buy this machinery. Now what did I do? Say for example, I will be getting these cash inflows. I will compare these cash inflows with that of the cash outflows, and if the inflows exceed the outflows, we will go for the machinery. If not, then we will not buy this machinery. Friends, in the question, so I'm telling you the basic overview is what you just have to compare the inflows with that of the outflows. That's it. The chapter is damn simple. Compare the inflows with that of the outflows. Outflows will always be given in the question. And for your information, even inflows will always be given. Maximum cases, even inflows will be given. If, however, inflows are not given, then the same can be calculated by preparing an income statement. So understand now, what did I tell you? Outflows in the question will always be given. For that matter, inflows will also be given. If inflows are not given, then the same can be calculated by preparing an income statement. Now, how will that income statement be prepared? Let's understand. If purchased this machinery, we know that this will help us to generate sales. So now I will prepare an income statement which will help me to calculate the cash inflows. One question that I want to ask you is, this income statement which we will prepare here, friends, tell me, will this income statement be actual income statement or an estimated one? Yes, definitely it will be an estimated income statement. So what I thought was, if I purchase this machinery, I think that I will be in a position to sell X number of units. Per annum, I'll be able to sell these many units. Then I will set a selling price of the product. Whatever be the selling price, once you multiply the selling price with the sales quantity, it will help you to get sales in rupees. Now friends, we all know that we cannot generate revenue without incurring cost. So we have to incur cost to generate these revenues. So then what will I do? From this I will now deduct the variable cost. Then I will also deduct the fixed cost. Variable cost, fixed cost. Now do you agree these variable costs are cash expenses? Fixed costs are also cash expenses. Sales is cash income. When I deduct cash income from cash expenses, I can say this amount. See friends, have I deducted depreciation yet? No. Have I deducted tax yet? No. So I can say this is nothing but net profit before depreciation and tax. We can also use an alternative term for this net profit before depreciation and tax. What? As we know that these are cash expenses and these are cash incomes, what I can do is cash expenses, when we subtract from cash incomes, the resultant can be termed as net cash flow. And since I haven't deducted tax yet, I can even say this is nothing but cash flows before tax. Now, will we have to pay tax on this amount? No. For calculating your tax liability, you are also allowed to charge depreciation. So now what we will do is, from this we will now deduct the amount of depreciation, and once we deduct depreciation, this can be termed as net profit before tax, or we can say this is nothing but the amount of taxable income. On this profit we have to pay tax. Now from the net profit before tax, what will I do is I will now deduct tax, and after deducting tax, the resultant can be termed as net profit after tax. Now friends, as I told you that this entire chapter of capital budgeting is going to revolve around two things: cash outflows and cash inflows. Do you really think that this will be termed as cash inflow? No. Why not? This is nothing but book profit. This is not my cash inflow. Why? Because to arrive at this profit, I have already deducted an expense which is depreciation, which is non-cash in nature. This did not result into outflow of cash, but then why did I deduct it? Because this was helping me to determine my taxable income, but this did not result into flow of cash. So in order to calculate the cash inflow, what I will have to do is I will have to add back the depreciation, and once we add back the depreciation, the resultant can be termed as cash flows after tax. The resultant can be termed as cash flows after tax. Now, this will be the cash inflow which I am likely to generate, because this is an estimated income statement. So I can say this is the cash inflow which I am likely to generate in, say, year 1. Same manner, I'll prepare an income statement for year 2, year 3. I'll get the cash inflows, I will dump it here, and then I will compare these cash inflows with that of the cash outflows. If I think I'll be able to get more cash inflows than the outflow, then I will buy this machinery, else not. This is that simple chapter. Now, there is an alternative way also to calculate this cash flows after tax. Let us understand now an alternate way for calculating cash flows after tax. This is in the form of an income statement. The alternate way for calculating this cash flows after tax, I can do it in a equation form. Let's understand how we can do it. Now, I can start directly with cash flows before tax. I want to reach to cash flows after tax, so I can start with cash flows before tax. So alternative way for calculating cash flows after tax, but in an equation form. Now how can we calculate that? Simple. You start with cash flows before tax. Now from cash flows before tax, what did we do? We deducted the depreciation. So cash flows before tax minus depreciation. So when I deduct the depreciation, the resultant becomes net profit before tax. So this part can also be termed as net profit before tax. Now if I want to jump from net profit before tax directly to net profit after tax, if something is before tax and if you want to convert it into after tax, the only thing that you have to do is multiply it with 1 minus tax rate. Cash flows before tax minus depreciation gives me net profit before tax. But if I want to jump directly from this point to this point, that means I have to convert the before tax item into after tax. Any item which we want, which is before tax, if you want to convert into after tax, you just have to multiply it by 1 minus tax rate. And then once you get this net profit after tax, do you agree? You have to add depreciation to get cash flows after tax. So what I'll do is now I will add back the depreciation and I'll be able to calculate the amount of cash flows after tax. Now let us simplify this part further. Cash flows before tax is going to be multiplied with 1 minus tax rate minus depreciation into 1 minus tax rate plus depreciation. Now let us keep this part as it is. So this will be cash flows before tax into 1 minus tax rate minus depreciation plus depreciation into tax rate plus depreciation. And when you solve it, you will realize that minus depreciation plus depreciation is going to get cancelled. So we can now conclude, therefore, one more way to calculate cash flows after tax is cash flows, take the cash flows which are before tax, multiply it with 1 minus tax rate plus depreciation into tax rate. Cash flows after tax can also be calculated in this manner. Cash flows before tax into 1 minus tax rate plus depreciation into tax rate. Now friends, do you agree? If the question is silent about tax rate, if we do not have any information about tax rate, then we can also conclude if tax rate is not given, then what happens? Cash flows after tax will become equal to cash flows before tax. In absence of information about tax rate, cash flows after tax, that is CFAT, will be equal to CFBT. I hope everyone has followed till now. So summary of all the discussion that we have done till now, friends, is what? This chapter of capital budgeting is related to taking decisions. But which kind of decisions? Decisions which are related to long-term assets or fixed assets or capital assets or long-term projects. Whenever we take decisions in respect of these assets, these decisions are called capital budgeting decisions. Unique part is what? The outflows associated with this will be immediate. Inflows will be spread over a number of years. Entire chapter revolves around calculating and comparing the cash outflows with the cash inflows. Cash outflows will always be given. For that matter, cash inflows will also be given. If cash inflows are not given, then we can calculate the same by preparing an income statement. Now, let us take the discussion a bit forward. What exactly are we going to do in this entire chapter of capital budgeting? Friends, this chapter of capital budgeting has developed certain techniques for evaluating long-term projects. It has developed certain methods for evaluating long-term projects, and we need to learn those methods. How we need to select a project on the basis of different methods, that is what we're going to learn in this chapter. So the next segment that we're going to discuss here is the methods for evaluating long-term projects. Methods for evaluating long-term projects. What are the methods that we're going to learn here? Now this chapter, as I told you, has developed various techniques for evaluating the long-term projects. Namely, the methods are, the first method is payback period approach, which is also popularly called PBP. The second approach is the net present value approach, more popularly called NPV. The third is the profitability index method, also called PI. The fourth which we gonna learn is discounted payback period. The fifth is the internal rate of return, which is more popularly called IRR. The sixth which we will learn is the average rate of return, or also called accounting rate of return, which is ARR. And the next one which we will learn here is the adjusted present value technique. Adjusted present value, also called APV. So these are the methods which we're going to learn in this chapter of capital budgeting. In this, friends, I can tell you, payback period and discounted payback period are almost related to each other. NPV technique and PI technique, as well as this APV technique, they are related to each other. So these three methods, they are somewhere variations of each other. Payback and discounted payback period are related to each other. There is no relation between IRR and ARR. So don't think, sir, rate of return word, rate of return same, hence similar. No, there is no relation between IRR and the ARR. So what we will do is, every method we will discuss in detail. We will understand what exactly is payback period. We will understand what is the decision rule, what are the advantages of payback period, limitations of payback period. Same way we will take up each and every method, and almost we will be following the same chronology for taking up the methods. And this chapter is all about understanding these methods. Is it okay? I hope everyone has followed this part.